Welcome to the Deep Dive from Futurelink. We're the show that, cuts through the noise to get you the facts that really matter. Today we are doing a genuine deep dive into what's being called the One Big Beautiful Bill. And specifically, we're honing in on how its different parts might affect you. Maybe you're a homeowner or thinking about buying. Perhaps you work in real estate or, anywhere in the housing world.
Exactly. And our goal today is pretty simple. Take this really complex legislation and just break it down. Make it understandable. We'll give you the key details, but skip all the dense legal language or technical stuff. And this is important. Everything we're sharing, it comes straight from verified government sources.
Yeah.
Right from the official bill document itself. So no guesswork here.
Okay, perfect. Let's unpack this then. Starting with something I know impacts a lot of homeowners directly. I'm talking about the changes to those tax deductions for state and local taxes. The solid cap, right? What's happening there? Is it a big shift?
Well, it's definitely a big shift. What's really striking is how much it changes that limitation. So you remember previously that deduction was capped at $10,000. Pretty strict.
$10,000.
Well, this new bill, it brings in what they call an applicable limitation amount. And that amount jumps way up. We're talking $500,000 for the tax year starting in 2025.
Wait, 500,000? From 10?
Exactly.
Yeah.
And then it goes up again slightly to $505,000 for 2026 with, adjustments planned after that too. This is, it's huge. Yeah. It fundamentally changes the math for homeowners, especially if you're in a state with higher property taxes or income taxes.
Wow. Yeah, that allows deducting a much, much bigger chunk of those costs.
A much bigger chunk. It could really impact people's finances, maybe even influence where they decide to live, potentially affecting property values too.
That is a massive change. Okay, so that covers homeowners' taxes. But let's pivot a bit. What about the bigger picture, like housing supply and development? That's always such a critical issue for the industry and, frankly, for anyone trying to buy a home. How does this bill tackle that?
Right, that's a huge piece of this. The bill brings in some pretty significant incentives for housing development. First off, it makes the Opportunity Zones program permanent and enhances it.
Opportunity zones. Remind us quickly what those are.
Sure. There are specific economically distressed areas. Investing in these zones, like in real estate or businesses there, it gives investors tax benefits. Think deferring or even eliminating capital gains taxes. Making this permanent offers long-term stability for those incentives, encouraging development, including housing, and there's a special focus on rural areas too.
Okay, so permanent for opportunity zones. What else?
Second, there's a permanent boost for the low-income housing tax credit.
The LIHTC. Very important.
Strongly important. It's not a direct payment, but a tax credit developers use to basically raise money, equity, for building affordable housing. Enhancing it means more potential funding for those projects.
Makes sense.
And then there's a really direct move on supply. The bill actually authorizes the Bureau of Land Management, that's federal land, to dispose of some specific parcels, specifically for local housing needs. The goal there is improving affordability directly by adding land supply.
So releasing federal land for housing. Interesting. Okay, so we have incentives, we have maybe more land, but development can still be slow, right? Does the bill address the process itself, make it more efficient?
Yes, exactly. That's another angle. It includes something for project sponsors, basically opt-in fees for environmental reviews.
Opt-in fees, how does that work?
Well, developers can choose to pay a fee to essentially expedite the environmental assessment process. The aim is to get those assessments done faster, maybe within 180 days for a standard assessment, or within a year for a more complex environmental impact statement.
So paying to speed things up could make a big difference for project timelines.
It could. It adds predictability, which developers really value. It might help get projects moving that were, stuck in limbo because of uncertain review times. And specifically for builders, there's also a change in accounting rules for some residential construction contracts.
Oh, what kind of change?
It's an exception to what's called the percentage of completion method. Basically, it simplifies their accounting. It means for certain contracts, they might not have to recognize income for tax purposes bit by bit as the project goes on. They could potentially wait until it's done or hits a major milestone.
Okay. So that could help with their cash flow and simplify their bookkeeping.
Precisely. It's about financial efficiency for the builders themselves.
Got it. We've covered some broad ground taxes, development incentives, efficiency, but does the bill get more specific? Are there provisions for homeowners in, say, particular situations, like rural areas or maybe folks dealing with disasters?
Yes, it definitely drills down into some specifics. There's targeted support included. For rural communities, for example, the bill introduces an interesting tax break for lenders. Qualified lenders can exclude 25% of the interest they receive on loans secured by rural or agricultural property.
So making those loans potentially more attractive for banks to offer.
That seems to be the idea. It could potentially make financing a bit easier or more appealing in those areas. So, if you're looking to buy in a rural spot, this might indirectly help.
Okay. What about unforeseen crises?
Disasters.
Yeah, for homeowners hit by disasters, the bill extends existing rules for how certain personal casualty losses are treated tax-wise. So it provides continued relief there.
Good to know. Anything else on specific homeowner situations?
One more significant one relates to long-term care planning and Medicaid. The bill changes the rules around home equity limits for Medicaid eligibility. It increases the limit quite a bit, up to potentially $1 million in home equity someone can have and still qualify for Medicaid long-term care services. Wow, $1 million in home equity. That's a big increase.
It is. It offers more financial security and, frankly, peace of mind for some homeowners thinking about future long-term care needs.
A really interesting range of impacts there, from broad tax policy down to very specific situations. And just a reminder, this deep dive was put together using AI and automation tools right here at Futurelink. We use real government resources to help you stay informed about these kinds of complex changes.
That's right. And if using tools like this sounds interesting for your own business or maybe your career, you can find out more. Visit us at www.futurelink.com, or you can just email training@futurelink.com.
Well, thank you so much for joining us on this deep dive. We really hope breaking down the One Big Beautiful Bill this way helps you understand how it might impact your home, your work, or the housing market overall.
Yes, stay informed, stay empowered, because really knowledge is most valuable when you can understand it and apply it, especially when it comes to something as